Hi, this is Zach with the Bulletin Board Heroes on Tuesday, the 14th of April, here on Share Talk and sponsored by the UK Investor Show. Good to see one of the most bullish periods in the stock market that's ever been. I would say it's reminiscent of what we saw after the global financial crisis, the middle of the dot-com boom and other rallies that there have been, even in the mid-70s, the rebound that we had after OPEC. So looking very strong indeed, and obviously sport for choice on the small cap area. Starting off with Asia Resources, here you can see the shares breaking through the 50-day moving average at 1.6 pence. And the view here is that while we hold above the 50-day line, we could hit the top of this broadening triangle from December as high as 3.7 pence over the next month or so. Bigdish doing well in terms of its price action despite the issues in the hospitality industry at the moment. One can see here the way that shares have broken back above that gap on the way down at 1.5 pence, and while we hold above that, looking for a move towards 2.5 pence, which was support between January and I suppose the early part of March. Also, that takes us back to the between the 50 and 200-day moving averages at 2.25 and 2.7 pence. Respectively. Worth noting the gap higher today in Dev Clever. Here you can see that shares breaking through post-March resistance around the 3.8 pence area. While we're above that, looking for a target as high as the top of a rising trend channel from October at 5.5 pence. Only really killing the bull argument here if we break back below the 50-day line at 3.04 pence. Small cap farmers certainly in focus at the moment, and Evgen, one of the best of the bunch at the moment. Here you can see breaking this November resistance line. That was at 5 pence, and while we hold above that, looking for a best case scenario target over the next 2 to 3 months as high as 14 pence, which is the top of a post-November broadening triangle. Ideally, there's no breakback below post-February resistance at 6 pence ahead of further moves to the upside. Sticking with the coronavirus pharma area, we can see that Genedrive has managed to hit the previous target here, the top of a broadening triangle from 2018, I believe. And view at this stage is that as long as we hold above the 50 pence area, we could still see a new leg to the upside, probably back towards the 80 pence area, which was the support area in the middle of 2016 on the way down for the shares. Leaving the pharma area momentarily, we've got a stock called Galileo Resources here. Here we've had a nice gap through the 50-day moving average, which is one of our favorite setups for a stock or market. Worth noting the way that the shares have broken a line of resistance that you can draw from basically the middle of August last year, and really while we're above 0.4 pence, looking for a further push towards the main post-August resistance at 0.75 ahead of any pullback for the shares. So looking pretty sprightly at Galileo Resources at the moment. Back to the pharma area, and N4 Pharma certainly looking as though it's ready to take off in a meaningful way. We've had this bounce just above the 200-day moving average at 3.6 pence, and while we hold above that, looking for a retest of the 8 pence area at the top of a broadening triangle from the end of June last year. Novacyt, clearly one of the stocks of the year, and I'm sure will be one of the stocks that remain one of the stocks of the year given the percentage rise that we've seen here. The target, the last target technical one here was up to £6, which was made last week. We could raise that up to about £6.50 given the way that January resistance line is heading at the moment. The best stop loss at the moment, I suppose, back towards 420 to 450, which is just below today's intraday low at the moment, but can only really tighten that up as we go through the week and see how the price action stabilizes after the recent massive spike to the upside. Good to see Orphan finally galloping ahead after getting slightly bogged down in the 6 to 7 pence area recently, or at least over the last few months. The view at this stage is that at least while we hold above 7.5 pence, which was last month's intraday peak, looking for 9.5 to 11 pence as the destination for the shares, 11 pence being a line of resistance from December, rather steep one. But that could be the best case scenario over the near term, and certainly would mean that the shares have broken out in a conclusive and comprehensive way over the past few sessions. Red Rock Resources is a bit of a blast from the past, coming back into favour at the moment. Here you can see that we've broken above recent neckline resistance at 0.2 pence, and while we hold above that, looking for the stock to head back towards support on the way down, which is between 0.35 and 0.4 pence as a base case scenario target. If you're cautious on the shares, maybe wait for a break of the 50-day moving average at 0.25 pence before pressing the buy button. Back towards the pharma space, and seeing here that Synairgen is threatening to break out of even the most optimistic trend line projection there. Currently, the best case here is up to 85 pence. Let's see how we go with that. And that would be valuable while we hold above 65 pence over the near term. I suppose stretching the bull argument a bit further, you can see that I had previously drawn a line of a projected resistance line projection up from 2015 heading towards 120, and a weekly close above the 80 to 85 pence zone could very well take the shares up towards that particular area. On to San Leon, and gave this a look, I believe, sometime last week, looking rather better than it did just a few weeks ago. Here it was all about really the stock holding the 18 pence area. That was previous support there in 2017, 2018. So the view at this stage is at least while we hold above that 18 pence zone, which we've just bounced off, we could at least retest post-September resistance at 30 pence. If you're cautious on the stock, maybe wait for the 50-day moving average at 21 pence to break, as that would be a decent momentum signal to build on the current move. But the gap higher, in fact the island reversal that we had for March, is a very strong signal in itself, and does suggest that the bears have been caught out by that sub 18 pence dip. Finishing off with one of my favourites of last week, Tiziana Life Sciences. Situation here is that we were looking for 60 to 70 pence when the shares were in the 40s. Obviously, we've had that particular target hit rather easily. The issue now is really where support will come in. Looks like it'll come in between 50 to 60 at the lowest, and at least while we hold about that area, one would expect 80 to 90 pence initially, and then a retest of last month's 160 to 170 pence resistance over the next few weeks. This stage only really back below the 200-day line at 46 pence, outright hurting the bull argument. That's it for me today. More updates tomorrow.